Hey everybody, Preston Bryn here with our weekly roundup brought to you by our trader user group. This is for the trading week ending June 23rd, 2017. What I've got on the screen here is a weekly chart of the S&P 500 E-mini futures. Before I jump into the details here, just this past week, we saw the oil markets officially dip into a bear market. And we're going to talk about oil in a minute. We saw China, they got a big win with the Morgan Stanley Composite Index, the MSCI, the global index that China finally got admitted to after like 4 years of trying. So that'll result in some money flow into China. And here in the U.S. banks passed a major stress test, so we're going to see banks probably offer up more dividends, at least some of the top performing banks. They're already on record as doing that. And we've seen a little bit of a lift in the financial markets because of that. Leading up to this stress test this week and the next week, we're going to see this probably come to fruition. But let's take a look here at the S&P 500 futures here for a second. What I've got on the screen, as I said, is a weekly chart. And if we go back in time here, let me just kind of label something right here. If I were to put this on here, and let me just draw a box in here, just like this. And we'll probably start it right there. How about that? Okay. So this is a long period of time, being a weekly chart. This goes all the way back to Q1 of 2014. Okay. And we come all the way over here to November, right, of 2016, which we all know that was the presidential elections here. And we've been in this rather wide range, okay? So if we look at the range and we go from the bottom to the top here, it is roughly, give or take, about 336 points, a little bit, So now in looking at this range, and we were in this for a long period of time, 2014, all of 2014, 2015, 2016, until the end here when we finally got up above it. We started to move up above in the summer months of 2016, but then we came right back down leading up to the election. And then with Trump, we've been on a tear. So with the Trump bump, we've just moved dramatically higher. But that's not the point I want to make. The point I want to make here is this range right here, taking that long to move up, becomes major key pivot points in running Fibonacci extensions, which is where we're trying to project up in this area right here. This high point here set a record back in 2015, a record being it took more than 400 plus days of making a high and coming back and taking out that high again. And that believe it or not, is, in the top 3 or 4 as far as once you make a high, coming back and making another high again. So really amazing. So that becomes a key pivot. All right, that's a key pivot high point. And then down here at the start of 2016, those are key, or just one of them's a key pivot low. That was one of the worst starts to the year in 2016. We were literally down, almost 336 points from 2136, right? So if you take a look at that, that is almost 15% down from the prior peaks up here in that start to 2016. So that's the key pivot low. So what I've done, as I said, these are really major pivots, and we've used these to generate the key potential reversal points as we go up into blue powder territory up here. So remember, once we started making this run up like this, okay, once we've started making this run, where do you project where we can run into trouble? And at every one of these projection levels, we've encountered some sense of selling consolidation before we moved higher. You can see a little bit there. You can see almost a month there. You can see we spent a lot of time at the 618 extension, and now we've extended off of that up into this area here. So the whole point of this is, where can we go to? And near term, if the sun and the moon and the stars all line up with Trump and some of his legislative agenda, because that's clearly where we are. That was the Trump bump right there on this weekly chart. And then we've just been moving up in hopes of that occurring. You can see here that we've got two areas that I'm watching, 2547 and roughly, call it 2550 and 2600. Now, will we get up there? I don't think so. These are the major areas here, longer term. I've seen everybody on TV, the TV talking heads talking about, you got one side of the table saying we're going to run up to 2600, 2700, another 10% from here. You've got others saying that we're going to fall a dramatic amount in the second half of the year. And, you know, I understand where each one of them makes valid arguments, okay? But what we do and what we work with in our user group is clearly following the price action. It'll tell you what the markets want to do. If you try and guess where you may be lucky, but odds are you're not going to be lucky, and you're going to lose a lot of money. Looking at the markets here right now on this weekly chart, we are setting up a little bit of a bearish divergence. Now, we call this our poor man's bed instead of an active bed, but nonetheless, it is still a bed that is in the process of being triggered. We've got a 3-leg, a 4-leg, and an Elliott wave 5. You can see this elongated 5-leg here, okay? And when you have a long leg on a 5-leg, that's typically because you've got a short 3-4 leg, right, from 3 to 4. And then we've extended up here. And at the end of an Elliott wave 5, you traditionally get an A leg in general, and then a B leg, and then you get a C leg. And then the market says, okay, what is our next trend that we want to take, okay? And the positioning of that A leg pivot, this B leg pivot, and this C leg pivot is going to kind of determine whether we're going to enter in another one of these long sideways choppy modes, or we're going to shift the polarity in the markets and we're going to end up going into a bearish market or into a recession. We've got the Feds. Last week I said that it is a yin-yang market, one of two realities. Basically, one is theory and the other is reality. The theory says the Feds, with all the stimulus and now hiking rates, inflation should be coming back. The reality is inflation's not coming back. And we're seeing oil prices go even lower. Bear market, as I said. I'll show you the old chart here in a second. With lower oil prices, with the CRB commodity index also on lows, is putting downward pressure on inflation. Yields on the 10-year are reaching lows that we haven't seen in over a year or so. 30-year interest rates are low. They're going lower. Short-term rates are moving higher because the Feds are raising the rates. What that's doing is flattening our yield curve, which is a projection of forward growth, which says that the markets don't believe everything that Yellen, aka Aunt B, is saying. So from that perspective, we got, you know, reality, that's what the market is showing, and then theory, which is what the quants and the economic professors and what the Fed's are trying to do. One of them is going to be right and one of them is going to be wrong when we get out into this area here. And since we do not know where price action is going to go, we take it a bar at a time. And we take the trades at a time. But the charts generally give us an edge in that we can generally be more than 55 to 65% of a probability of a relative bias based on the chart pattern we see. Now, we go through and spend a lot of time on that in our user group. If you're not part of it, I highly recommend and encourage you to come in and join us. But short of that, this is where we're sitting right now. And then if we come in and let's zoom into a daily chart. Remember, on the weekly, I said it's showing weakness. On the daily chart here, we also have a 3-4-5 pattern, right? The 5-leg typically indicates the upward momentum is slowing, and we're going to go into a choppy period here, okay? So, and you can see this volume over price is at these levels like this. So each of these levels becomes a support point, which not surprisingly, they kind of line up with our Fibonacci extensions, okay? So I would not be surprised to see us come down and find a support somewhere in this area here, which, as you can see on that fib extension, is pretty much where we've kind of found a happy place for price action. And we're getting at this extension right here like this. So there is another little minor point right here like that. Call it 2400. And you can see in that area there, and if I were to just put it in a box, you can see the box very clearly. It's always clear when I draw it in, right? Like that. So you can see where this is where the market is probably going to find itself as we go into the end of June, into July. Now, that's not a very big drop if you think about it. I mean, we have not had, I think, more than a 2.8% drop this entire year. The maximum drawdown for 2017 for this year has been 2.8%. And that's the second smallest first half of year drawdown in over 89 years. I mean, it's just, it really is amazing, right? I mean, if you look at it, and if I come in here and it just shows you how quiet the markets are. And if I come in at the top, we'll mark this, right? And if we come down to just the fib node right here of 2341 from the high, that's about a 4.4% pullback, okay? Just a really simple 2.8, that takes us down right about, I don't know, right there, right around 2384. This, guys, is the biggest drawdown we've had in the markets year to date. It's really amazing. And you know, the second longest period in 89 years, as I said, for the first half of the year. So we're going to find the markets, I think, in the second half of this year be a little bit different than the first half, okay? But this is where we're looking here. There is no signal on this chart that would indicate weakness much beyond 2 to 4% to the downside. I do believe that as we go into July, and I'll show you when we get in the volatility charts, that I think the markets will probably find a resting place somewhere here, unless we get some kind of existential event, and then the next resting pace is going to be somewhere down here around the 2250, 2275 area. Okay, so these are two of my favorite spots here where I would look to see the markets pull back. And should we break that, then it'll get uglier. But I do not see any of that happening over the summer months. Okay. And if we come over here and we look at volatility, and as you may have read in my little blog posting, volatility here, just to show you the record we're setting. In the past 20 years, the VIX has closed lower than 10 on just 11 trading days. And of those 11 trading days, just this month alone, we've had 7 of them. It's amazing. Over the past, 20 years? And that wouldn't be surprising because this is a 20-year low right here at 937. Now, if I put it on a weekly chart right here, let's just bounce out to a weekly for a minute. And let's just zoom out. Let's really take it out. I just want to show you guys something here. And if I come in here, well, let me just get it to where I can see the months on here. Okay. All right. So if we come on here and then look at the month of July, right? So if we look, here is the month of July right there. That was really bad. It kicked off in July right there. That was a harbinger of things to come, right? Here's the month of July right here, right there. Here's the month of July right there. Let's try this one right here. Let's try this one right here. We'll come out here like that. So all I'm doing is I'm just picking the summer months that we've seen leading up to this summer right here, okay? So looking at the month of July, I'm looking at July and August essentially, and maybe part of September. But I'm going back 2, 4, 6, 8, 9 years, right? And you can see generally the average outside of this one right here back in 2015, after that horrible start to the year in 2015, generally, you know, in this one we were in the red zone. Here we were in zone 3 right there. The red zone is zone 4 for volatility levels 3, 3, 2, 3, 2, 2, and 3. All right, so now remember, zone 2 is vol is higher than 20, 21 points. Zone 3 vol is higher than 30. So in the month of July, August, and part of September, you can see the markets tend to have an upward cant in volatility. Okay, now this was the crisis and a black swan back there in 07 and 08. You can see the VIX actually got up to 96, 95. And the VIX was not available in 1987, but I read some stats that said if it was around based on the calculations, it would have been up at 150 when the markets fell over 25, 26% in a 2 or 3 day period, over 20% in one day. But back here you can see, but the whole point of this exercise is to show you that the month of July and August is not a very happy place for the markets, okay? And we've got to be very careful. I mean, we've just got to be very careful here. So as we come in here, and let's just zoom in on this, let's go back to the daily chart again. And you can see on this daily chart where we hit this, you know, decades low back at June 9th when vol actually closed at 937. And you can see over the past, since June 9th, vol is just extremely low. I don't expect it to stay here very long. And then when we do have spikes, it comes back down again, but just enough to kind of scare the children, right? Now, these recent spikes have taken us up to about a 16 vol, but even a 16 vol is very low, right? I mean, just really an extremely low period, or a low vol setting. So July is statistically going back 2 decades, one of the worst times for the S&P as far as going down and vol going up. And you know, you've heard the rumor sell in May and go away. Well, we're through June now. June has been a very quiet month, and now we're coming into July and August, which we tend to see more volatility come back into the market. So you want to be careful here. Okay, I mean the net of this is you really want to be careful. If we come in and look at NASDAQ, because NASDAQ was on a tear. We're seeing some sell-off in NASDAQ. And I believe that this run up in NASDAQ like that is more of a bull trap. It's going to break and we're going to come back down here again. We may even come up and attempt to make a new high. I don't see a new high being making before we roll back over again. Okay, it took a while to take out 5,800. We poked our head up. You can see on the daily chart there is no bed. There is no divergence here. So as I said, that would indicate any sell-off. Buyers will step in, and you can see that 50 EMA, that red line, you know, provided firm support. So we're going to go back to this red line again. Should we break this upsloping channel right here to see if that provides support for us, okay? And if we look at the individual stocks that make up over 40 or 50% of this index, you know, that would be the big guys, Facebook, Amazon, Apple, Microsoft, Google. They've all sold off a bit as well. They're working their way back up, but I'm not sure if a new high is going to be made in NASDAQ, okay? Now, the Dow has also been moving up very strong as well. You can see the Dow is off from the highs, all-time highs made on the 20th this past week, right? I can see a little bit of a pullback in the Dow, but nothing significant. The Russell, which has been the weakest, you can see here the 50 EMA, we're in a clear channel to the downside on the Russell. I mean, if I were to draw it, right, that is clearly a channel to the downside. But the Russell has got its own issues. If I were to really step it out a little bit, you can see with the Russell, we've been in a tight holding pattern for quite some time, right? You can see all this volume over price sitting right here. And we're towards the upper boundary of this channel right here, this where we've been stuck. So I think we're going to see some downward pressure, sideways to downward. But basically, the Russell has been trading in a chop, sideways pattern, which is good for some swing trades. But most of the trends that we're seeing now are not holding up for more than a week or so. The prior week, we saw industrials lead the way. This week, we saw biotech lead the way. Technology's been leading the way, but then over the past couple of weeks, it's been pulling back. So we're getting some rotation in the markets, but nobody's really holding a trend more than a few weeks on the near-term basis, okay? So we're just seeing money changing hands. If we look at the bond market, all right, it's off of its highs, but look at this. We're near the 2017 highs. And like it almost looks like the S&P 500 E-mini futures, right? You can see here, we've got this 3, 4, 5 pattern, which would suggest we're going to get this ABC pattern, right? At least a little bit of sideways chop. We came right up and hit my target, you know, both in time and price, right up there. I mean, maybe a couple of ticks south of my target. And I said up in this area, I am going to be more of a happy camper. If I get a short signal, I will be looking at that to give us an A leg down. And then the markets are going to determine, you know, if this is going down and the equities are moving up, where are we and everything. There's going to be a time and place where we have bonds moving down and equities moving down at the same time. Not quite sure we're there yet, but we're going to get close, all right? You can see the bond market, though, has been on a tear. We're at the 2017 highs. They made a 2017 high on the 22nd of June, okay, this past Thursday. And we closed at the highs on Friday. So we got that bears very close watching. The U.S. dollar, meanwhile, is kind of going along with oil. The dollar says there's no inflation, there's no interest rates, regardless of what Janet Yellen is doing. You can see this trend line on the dollar futures, dollar index. Down, 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 down. I said any up move is probably going to be sold off. We had the 50 crossing the 200. That is a longer-term bearish signal. I think the dollar over the rest of the year, outside of short counter trend moves up, is going to be doing this kind of thing and staying in that channel like that, right? That's kind of where I see the dollar. And then for the euro, it's going to be just the opposite. And as soon as the euro, and you can see we're near the 2017 highs of the euro. We're just in this little area right here because Super Mario Draghi has not come out and said we're going to take our foot off the accelerator with stimulus. But as soon as he announces that, I think over the next 2 weeks the euro is going to take that out and move up to the high 113s, low 114s to the U.S. dollar. You can see the cross in the MACD above the zero line. This is all bullish, guys. And you know, we played the euro to the bullish side. That's where you got to be. All right. The British pound is a sticky wicket, as they would say over in London. You've got this counter trend move here, which, you know, if I put the lines on it, you can see it very clearly on that channel to the downside because of Theresa May and all the issues that she had there. When it took out this right here, I was bullish. When Theresa May called that election, she did not fare very well, and now we're back below that takeout point right here, which is the 128. So I want to wait until this resolves itself. I do believe in the next 2 or 3 years, the pound is going to be back up in the high 30s, but it's going to be a lot of chop getting there. So it's, in many respects, it's a little bit harder to trade than, say, a longer-term play in the euro. You can play the euro, or you can play FXE, or you can play UUP, which is the ETF that tracks the dollar index, but trade that to the downside. Gold, meanwhile, had this move right here. Remember what I said about gold? When we went into the beginning of the year right here, I said gold's going to finish the year higher And now in hindsight, you may say, well, yeah, but look at where we entered the gold. I mean, this after this huge waterfall move. And then that move right there, people are expecting gold to just keep right on going down. And when we got into 2017 right here, I said gold's going to finish higher. And sure enough, we started forming this channel. You can see the width of this channel like that. Makes it appear like gold has got a lot of bearish tendencies because it comes down towards the lower part of the channel, right? And then it reverses and goes to the upper part. And as long as it kind of holds this up without breaking the channel and taking out a prior key pivot low, we're going to be chopped to mostly higher, okay? I do believe over the next couple of weeks, gold may inch a little bit higher as long as inflation stays subdued. And we're going to see gold react accordingly to this. And by the way, it's the same thing with silver. Although silver's been slightly, been a little bit of a worse performer. We've had this little bit of a sell-off here. And I do believe that silver's got a little bit more to prove to the upside, but it's going to be very choppy. Okay, I am not ready to declare I'm going to go in longer term long gold, because coming back to gold again, you know, it held very nicely, as you can see, on the 200 EMA, and we're sitting right on the 50. So I want to see this resolve, come back up. If we can clear, you know, around the 1260, 1270 area, moving on up, then I will be more interested in coming back and challenging this area here, because we had a double top from here to here. And then we just started selling off again. If it clears this area here, then, you know, clearly it's going to be a little bit more of a bullish play in the gold market. And then obviously for those that play gold, you can see the gold miners are one of the bigger ones, GDX. It's got the same image here, but with GDX, you know, if you connect the dots here like that, and then just draw this line like this, you've got that kind of pattern right here, the descending triangle, which suggests the break is going to be to the downside. So unless we can change this pattern and have a pattern break, I still think there's a little bit more downside in these trades. Oil, however, is just on a tear. We made new 2017 lows. I told our members we've been playing oil every week for the past 13, 14 weeks, and we haven't lost a week yet. We've had to adjust a couple, but we haven't had a losing trade yet. And you can see here the lower high and the lower low. I mean, it's just classic textbook trend. And you can see down here, there are no divergences down here. This suggests that any counter trend move here is going to be met by sellers, right? And I just don't see us getting up more than this area right here before we sell off again, if we're ready for a counter trend move. And it could be we're going to have a long choppy move here. But you can see that I can see oil coming back down into the high 30s before we start to get more serious buyers coming in. So that is the momentum that I see in the oil market. And if we look at gasoline prices, look at gas futures. Let me just take this off the screen right here. You can see with gasoline futures, we're taking out key pivots, and we're not really getting the divergences I would like to see to say, hey, let's go long. You know, you've got these lower lows in here. You've got these lower highs. That does suggest we could have a counter move somewhere up in this area here. We're looking at this thing, typically where the 50 crosses the 200 turns into a resistance support point depending on the direction of the price. The 200 EMA is big for gasoline futures. And remember, we're coming into the July, August, which is summer months, which is where traditionally we have the biggest drawdown in inventories and we have a bump in prices. We're not seeing that. We're doing just the opposite. We may be running seasonality-wise a couple of months behind. I'm going to want to go long gasoline and oil, but now is not the time. Okay. Now, we've got other things going on in the agricultural market, meats and softs. We're not doing any of those trades at this point in time. So again, that's where we're sitting on the markets, guys. For those of you not members, I'd highly encourage you to come on in. We're going to have a great second half of the year here. Otherwise, make it a great weekend. We got the 4th of July weekend for those of you international folks dialing in. We got a 4th of July coming up. It'll be a long holiday week next week. It's going to be on a Tuesday, 4th of July. The markets will be closed. The markets will be open on Monday, but some people will probably take a long weekend, and volume is going to fall off the table. So next week, as we go through the end of June, we'll see volume drop off. And then the following week, it'll stay low. And then we're officially into the summer months with July, where we're susceptible to lower volume, higher vol spikes on an intermittent basis. That, at least statistically, is what we're looking at. I do believe we will see some of that in the month of July. So otherwise, have a great weekend, everybody. And members, I will see you tomorrow night. See you guys. Ciao.